Hello and welcome. I'm Chieh, the President of the Institute and Faculty of Actuaries, and it's my pleasure to welcome you again, this time to the third event of our Finance in a Public Interest Seminar Series. I would like to firstly acknowledge that this series has been generously sponsored by Hong Kong-based philanthropist IFoA Fellow Dr. Patrick Poon and Milliman Consulting. Thanks to their support, we are able to host this event today free of charge to both members and non-members. At the last count, there are now 600 people registered for today's seminar, and I would like to extend a very warm welcome to you all. In the last 2 days, I've given the context of this program, the Thought Leadership Program, and also the Presidential Speaker Series, the original inspiration and background, and I shall not belabor the same points again today, except to say that we aim to bring thought leadership to the foreground of the IFoA once more, and to reposition the IFoA as a center of key societal debates, and to build our reputation as an authority to execute our public interest duties, and to use this current time of the COVID-19 pandemic as an inflection point for the IFoA to do things differently, with greater courage and imagination in expressing our thought leadership, and therefore widening our engagement and influence with the outside world. We had a great and engaging session on Tuesday on radical uncertainty anchored by John Chieh, and our discussion extended into the shortcomings and failures of regulations in two industries, the pharmaceutical and the financial service industries, and the disaster of moving from defined benefit to defined contribution in the pension sector in the UK. John Chieh also wondered if we are attracting the right people into our industry. Yesterday, we were joined by Sir Paul Collier, who offered his view on culture, greed, and ethics within the financial industry, and questioned the role of actuaries and actuarial methods in two examples, including the USS pension scheme and how no one saw the pandemic coming. He was provocative in saying that our foolish actuarial profession has done much damage in the area of pensions, and that our risk assessment was completely disastrous. His criticism must be seen in the context of his overall criticism of the professions, which include lawyers, economists, and accountants, where there has been an increase in specialization and a decline in ethical standards in the last 50 years. Today, it is a panel discussion amongst our own actuaries. Each speaker will be given 7 to 8 minutes to make their opening remarks on the general heading of finance in a public interest from their own personal and intellectual perspective as actuaries and members of the IFoA. All of them have followed the discussions in the last 2 days and are familiar with IFoA's intellectual positioning in the last few years. In their own respective ways, they have been instigating for change, and for IFoA to raise its profile and express its thought leadership and purpose, and to participate in the wider conversations impacting our work and society. 3 of them are members of the informal group Actuaries for Transformational Change. Lucy comes from the Sustainability Board, which is also heavily represented in that group. I will introduce each speaker before they make their opening remarks. After all the panelists have made the remarks, there will be a question and answer session. You can submit a question or at any time via the online Q&A function only on Zoom. And I would encourage you to, all of you, to do so. And this will give us some time to structure the questions more systematically. This session is also being recorded and will be available to be viewed on our website. Ashok Gupta. Ashok Gupta is a successful actuary, executive, and entrepreneur, and his career stretched over a period of 40 years. I remember meeting him when he was a consultant at Tillinghast, and then he was in St. James Place, Scottish Amicable, Scandia, CGU, Kinect, Old Mutual, AA, in a variety of roles, CEO roles, consultant role, chairmanship roles. Yeah. And his abiding passion is that IFoA must change and must be consequential and speak up to the big issues of our time, especially those which have a regulatory impact on investments and actuarial matters. His CV is on the slides, and now he spends most of his time on company boards and advising on policy. His current directorships include Chair of Mercer, UK, Chair of eValue, Non-Executive Director of Canadian-based multinational Sun Life. And he has done work with the Bank of England, FRC, PLSA. And he has been very involved with IFoA to build FinStick, the Financial System Thinking Innovation Group. And he's very passionate about this. So with this as an introduction, I present to you Ashok Gupta.
Thank you, Suee, and it's a pleasure to be here this morning with you all. And I'd like to say that I'm speaking in a personal capacity this morning. If we're going to reduce inequality and achieve carbon neutrality, we need to change the way in which we allocate capital within our society. So I want to start this morning by focusing on the investment industry, the investment system, because that's key to how we allocate capital. And I use the word system deliberately because it's essential we look at these sorts of problems through a systems lens. And investment is an area where we as actuaries play a vital role, quite often in ways we don't fully understand and appreciate. Let me define what I mean by investment. By investment, I mean putting money into businesses which produce products and services for customers which they value, and through that, the company generates value, which enables it to provide a return to the capital providers. This takes time, it's long-term, and it's value generative. By investment, I do not mean taking short-term bets against the market, which in my view is a zero-sum game and doesn't create value. Where does investment monies come from? Well, it comes from people like us, individuals, because it's individuals that own businesses and companies. In the UK, the aggregate financial wealth of individuals is approximately £8.2 trillion. 3/4 of this is savings for retirement. And this is investments made through life companies and pension funds. In OECD countries, life companies and pension funds provide 80% of long-term investment monies. It's the lifeblood of our economies. The investment system at its simplest operates like this. Individuals like pension funds and life companies and wealth managers, individuals pass money to pension funds, life companies and wealth managers, who in turn pass the money to fund managers, who then place that money with companies. These companies generate wealth, which is passed back as return to the investors, to the individuals. And of course, there are lots of other parties involved: financial advisors, investment consultants, capital market entities. But I want to focus on two entities: the asset owners, by that I mean life companies and pension funds, and the fund managers. Within any system, there's always a tendency to focus on the participants and a tendency to not focus sufficiently on the connections. And the connections here between the asset owners and the fund managers is particularly of interest, and particularly of interest to actuaries, because the connection here is the asset allocation strategy and the consequent investment mandates that asset owners give to fund managers. And the way that we actuaries measure and manage risk determines the asset allocation strategy and the form of the investment mandate. Because we actuaries measure risk using a short-term balance sheet approach, using asset price volatility as a measure of risk, this leads to matched investment strategies and short-term mandates. It leads to a supply of bonds and credit, not risk-bearing equity capital, which is the sort of capital we need to build infrastructure and green industries. In my view, this represents an erroneous mismatch of risk. Risk for life companies and pension funds and for their customers is inadequate investment returns or an inadequate pension. It's not short-term asset price volatility, especially given volatility diversifies over time. And of course, because we all use the same risk measurement and we all have similar asset strategies, we all chase the same assets. We all buy them at the same time, we all sell them at the same time, and this drives procyclicality and asset bubbles. I should recognize that our risk measurement is driven by regulation and accounting, which is underpinned by market-based economic theory. But what's overall happening is that in our attempts to eliminate idiosyncratic risk at the corporate or fund level, we're creating systemic risk. If I stay at the macro level, I want to focus now on our insurance industry and how our insurance system manages risk. In the insurance system, you have three main parties. You have insurance companies, regulators, and customers. Insurance companies seek to underwrite risks that will deliver an adequate return on capital to their shareholders. The regulator seeks to ensure that all risks are adequately capitalized. So if you view this as two overlapping circles, what happens is that insurance companies all gravitate to those risks that fall within this intersection, and they shy away from risks outside it. So this leads to a build-up systemic risk as everybody chases those same risks. Now I add in a third overlapping circle, the risks that customers or society wishes to insure. Picture, if you like, 3/5 of the Olympic symbol. The intersection of these three circles are risks that are attractive to insurers, regulators deem adequately capitalized, and customers want to be underwritten. So what's in this intersection and what's outside? Inside, things like annuities, credit, term insurance, unit-linked investment, general insurance for lower risk individuals. Outside are investment guarantees, infrastructure investment, mass market investment advice, long-term care, affordable insurance for higher risk drivers and houses in floodplains. This intersection is insufficient. It's just too small to meet the needs of customers and society. The insurance system and the relationships created between these three parties and the investment system dysfunctionality that I've described is responsible for the great transfer of risk from corporates to individuals. It leads to transfer of wealth between generations, contributing to intergenerational unfairness. It's also responsible for reducing the supply of long-term risk-bearing capital to industries and to build infrastructure. If we're going to drive capital to achieve carbon neutrality, to drive capital to meet the needs of the disadvantaged in society and reduce financial exclusion, we need to align the way regulators measure risk so they reflect actual customer risks. And it's also essential that we measure risks over a longer time frame. A 20-year risk is fundamentally different to a 1-year risk looked at over 20 consecutive years. We also need to start looking at our financial industries as complex adaptive systems, so we can understand how and when we're creating systemic risk and to ensure our financial systems are meeting their purpose. That's why we've set up FinSTIC, the Financial Systems Thinking Innovation Center, because we believe our financial systems are not meeting the needs of the economy, the environment, or society. So I'd like to thank Chieh and the IFoA for the support in this. The review of Solvency II, Financial Services Regulatory Framework, and COP26 provides the opportunity for a reset of our financial systems, and we as actuaries need to grab this opportunity. Thank you.
Thanks, Ashok, for such a effective and comprehensive exposition of the key areas. Yeah, and we'll go back to it. And many of these points were touched on in the last two days. But what left on my mind was two things, two or three things. The first one was on short-term risks and zero-sum games, and that is driving behavior instead of long-term measurements, and especially in investment mandates. The second one was your very descriptive intersection of Venn diagrams. And the space is too small for consumer interest to be served by regulation and the financial institutions. But unpacking that will require us to go back to, I think, finance theory, modern finance theory, which I think we need to start thinking how best to do it. And it persists into pensions and life insurance, obviously. And there's a whole assumption about how business should be measured, right? And sustainability should be measured. So thanks for opening the discussion. The next person is Lucy. I met Lucy one-on-one only for the first time a few weeks ago. She's very passionate, idealistic, and in a very positive way on sustainability, climate change, fairness, and also intergenerational fairness. And she's concerned if IFoA should not be too behind the curve in terms of rethinking the foundations of our work, which is currently on neoclassical economics. Yeah, she has an abiding concern about that, and we have been in that space before, about 25 years ago, of being too slow to respond to changes around us. As you can see from the slide, she is qualified as a vet as well as an actuary. She works in Aviva today, concentrating on climate risks and opportunities. She will be the next chair for the IFoA Sustainability Board. Now she's doing work for Sustainability Development Goals, and she co-chairs the Intergenerational Fairness Working Party. And she's also a member of the Economic Members Interest Group. So with this, I will hand over the floor to Lucy Saye.
Thank you, Chieh, for inviting me to speak today, and what a great intro there from Ashok. I'm going to build on and hopefully complement some of the things that we've spoken about this week. And probably unsurprisingly, I'm going to touch on some sustainability aspects to highlight our collective failures in recognising social and environmental outcomes in our definition of economic success, including what this means for intergenerational fairness. So it's increasingly recognised that economic performance is underpinned by what we call ecosystem services or benefits. It might be natural resources like food, raw materials, or medicine, or it could be intermediate processes like pollination or nutrient cycling, or equally the breakdown of our waste products, so carbon storage, biological breakdown, or removing pollutants. But one thing's for sure, that these things allow our societies and our economies to function. We also get social and cultural benefits from nature, so access to green space is important for physical and mental health. And nature often has a role in arts, culture, and spiritual practices. But despite these benefits, we've been pretty bad at recognising them in the role of generating economic activity. And I'm just going to touch on some of the reasons why. So many of these services don't have a market price, and something picked up by Mark Carney in his first Reef lecture was the movement in economics to a subjective theory of value in which value is equated with price. And of course, in the case of nature, it means we don't reflect the true costs in our economic valuations. There's the added complication of a delay. Nature can withstand quite a lot, so soils can degrade whilst crop yields stay the same for some time. Carbon can continue to be emitted long before temperatures increase, and the exact point at which these services are undermined beyond repair is uncertain. And then the damages we do experience are unequally distributed, and that means that those who are often responsible are not the ones feeling the most severe impacts. And this could be a consequence of geography, or it might be on an intergenerational basis, or it could be as a result of the structural inequalities of society as pre-existing vulnerabilities interact and weaken resilience. Together, this means we collectively overuse both nature's sources and sinks, and this is amplified when we fail to recognise the degradation of the natural environment in our assessment of economic performance. But what this means is that we undermine the resilience of our economies and we impair the ability of future generations to share in these same benefits. So clearly these are issues that are relevant for the public interest, but what can actuaries do about it? Well, in short, every economic activity is financed by someone, and a large proportion of economic activity is insured by someone. And a great many of these organisations rely on actuaries assessing economic outcomes to make decisions. Many of these organisations have a long-term focus, which means they're unable to diversify away such large-scale negative externalities because the impacts are borne across the entire economy. And together, this means that these institutions and the actuaries that work in them have an incentive and an ability to act. Whilst of course not overstating our influence, our skill set is well suited to the assessment, management, and perhaps most importantly, communication of complex long-term risks. And I'd support previous speakers in this series in embracing a broader perspective. As actuaries, we rely on economic theories and techniques, and I've just outlined some of the limitations in relation to environmental challenges, and others in this events programme have outlined some of the ongoing key debates in this field. For me, one of the biggest failures has been the lack of emphasis on economic pluralism. There isn't only one way to do economics, but so often it's presented as a set of facts free from any external influences like politics or philosophy, which of course isn't true, and it limits our ability to solve problems in the real world. So one of the things we can do as actuaries is recognise different economic schools of thought and work to understand the insight and the limitations that they bring with them. Additionally, we need to think of true pluralism as stretching across discipline. So what insights can we get from anthropology, from history, from ecology, from systems thinking? How does this impact, and how is it impacted by politics, regulation, and the law? And this involves questioning and challenging the underlying economic assumptions in our models. What is in our models, what is not? What are all of the costs and benefits, even if they don't have monetary values? What are the impacts on society, both now and in the future? Something else for us to consider is uncertainty, which has been another theme running through this series of events. And it's particularly important in the case of climate change and biodiversity loss, where there's radical uncertainty, complexity, and irreversibility or tipping points. It's also relevant in the case of innovation, where spillovers add to the uncertainty of outcomes. And a recent example of quite a nice positive spillover is the RNA technology that has been used in the COVID-19 vaccines, which is now being built on to develop a vaccine for malaria. So whilst that's a positive externality, such a benefit is unlikely to have been captured as part of a traditional cost-benefit analysis. So in these situations, we need to think about what this means for our models and decision-making. How do we account for spillovers? How might we deal with a change in the structure of the economy as we decarbonise? And collectively, as a society, it requires a recognition that environmental and social outcomes are not separate from our economic outcomes. We need to find ways of evaluating all three together. This was picked up in the Gupta review on biodiversity commissioned by the Treasury and discusses the concept of inclusive wealth. So human capital, produced capital, and natural capital. And this recognition is certainly welcome. Lastly, we should recognise that there isn't something innate in markets that means environmental or social damage is inevitable. Markets are man-made systems. It's people with our underlying values, morals and biases that write the laws, regulation, governance structures that deliver those outcomes. If we want different outcomes, if we want sustainable outcomes, we need to think about how we achieve that. I appreciate that's quite a lot of information. I'll pause there and let people reflect and hand back to Suee Chieh.
Thanks very much, Lucy. And you cover quite important ground. And reflection is actually quite a good phrase. Yeah. And as you were speaking, two thoughts came to my mind, and I think we are going to return to this. Yesterday, it was John Chieh actually, so it's 2 days ago. He says about mankind's need to calculate, to measure, and a great desire to put a number on it. Yeah, and our profession is built on that, right? But now we are saying that we should maybe be more aware of other ways of measurement. And in our own conversation, you talked about well-being and social well-being as alternative measures. What does it mean to us as actuary is actually very profound. And I see this not necessarily as negative, but actually as an opportunity to really go to a higher order about what is it meant to have good outcomes, right? Because currently good outcomes are basically measured by prices and GDP, which you and Mark Carney and are saying is inadequate. So I'll leave it at that space and introduce our third speaker. Yeah. And if you, actually I forgot to mention to the speakers, when you see me appearing on the screen, it means your time is roughly up. I would like now to introduce Nico, who is a radical, unorthodox and innovative thinker. He has a background in theoretical physics, yeah, and you can see his CV on a slide, yeah, and I'm sure his ideas would be challenging and refreshing, yeah. Currently, he's a Chief Investment Officer of B&CE, which is actually stands for Building and Civil Engineering Group of Unions, which includes the People's Pension, which is the largest DC master trust in the UK. Closer home at IFoA, he was ex-chair of the Resource and Environment Board, which is a precursor of the Sustainability Board, and he was also chair of a research subcommittee of that board. His previous roles included roles in Willie Towers Watson, Barclays UK Retirement Fund, as well as Deloitte's. Yeah. So with that, I'd like to hand over to Nico.
Thank you very much, and thank you very much for inviting me to comment on this really important topic. I thought I'd come at it from the angle of talking about first what is the public interest, and maybe my theoretical physics background will kind of ring through in the way that I address that, and then secondly what the role of actuaries are, because I think it's really important that we think about our positioning within this system. So the public interest. I think it's always been a struggle for the IFoA to talk about the public interest, because we've recognised that individual actuaries can't act in the public interest, that they have to act within a corporate or to advise a specific client. And so the role of the public interest, or the role of defining it, has fallen to the IFoA. For myself, I think the public interest is much broader than that, and actually actuaries themselves certainly need to be conscious of it and ideally act in the public interest. And I would align the concept of the public interest to public goods and commons. So in economics terms, talking about capitals which sit outside of the systems that we run and manage. So Lucy mentioned sustainability, environmental capital, so making sure that there is trees to deliver oxygen to us and hopefully to absorb carbon dioxide. We can think about social capitals, so ensuring that we have communities to live in, society that educates us and supports our mental health. And of course, we can define a huge number of different capitals. None of them are very important to the corporation as we currently construe it. The corporation really is very focused on financial capital, which in my view is the only capital which isn't a capital. So it's really the measure of how you can exchange capitals, and it is not a capital in itself. So we have this sort of funny system where corporations are very focused on the one thing which isn't capital and unfocused on the things which are most important. And I would link these capitals to the concepts of sustainability. So they're all networks. They all rely on multiple agents exchanging between themselves. And I don't mean money, I mean services. And they are all vulnerable to collapse if you push those networks too far out of kilter. So we have corporations who are very focused on the wrong things, and measuring and creating metrics of profit as opposed to sustainability. And I do think there are good examples, and I think you can find and define a role of the corporation of the future to be focused on capital and realize that profit is an outcome of building capital. I think this aligns to the concept of adding value. And that measures of the capitals that you interact with and seeking to improve them, or indeed have threshold criticality as to when they might be on the verge of collapse, would link towards a more sustainable corporation. So, that would then be encapsulated in a word which a number of corporations are starting to use, which is purpose. So the purpose of a company is not to make profit. Whatever Milton Friedman is misquoted, I think in fairness, as having said, the purpose of a company is to add value. And if it adds value well, like builds those capitals, doesn't erode them dangerously, then the profit will flow. So economists call these capitals externalities. I think that thinking about the public interest, public goods, commons makes them integral to the role of the corporation. So what is the role of an actuary in that world? Well, I would see an actuary as being someone who can cope with the multi-perspective problems that having multiple stakeholders comes with. So no longer should they be focused on a financial metric and thinking about only shareholders or only risk holders. We should be broadening that out to all of the providers of capital. So human capital, the staff, but also environmental capital, the oxygen they breathe, the clean water that they drink, the food that they consume, and again, bringing the plurality of different capitals into that conversation. So actuaries use maths to go amongst those stakeholders and find common language, a common model for how they view the corporation or the collective interest that they have. But we have to recognize that there is no one set of maths that can capture that objective well. These are wicked problems, which means that each of those stakeholders will have a different understanding of what the problem of the corporation is there to provide. So we probably need plural maths, which means that one model is the worst possible outcome, two models, which gives you different perspectives on a problem, can indeed give you the ability to understand that there is no perfect solution, the world is full of compromise, and the actuary is the arbiter of that compromise. And we also have to recognize that there are some topics which are just simply unmodelable. So there are some topics which are beyond maths, and the actuary again can use their skill set to talk to scenarios. So they may have mathematical results, but they may not carry a mathematical route of getting there. And of course, then I think there's a topic of ethics, which all professions need to grapple with. And we need to put the actuary into the role of the ethics of process. So a well-followed process which talks to the purpose, which results in a strategy which reflects the purpose of the corporation, is an ethical process, is an ethical strategy. Whereas a company which takes actions which are against their purpose. So I linked to Ashok's comments on things like derivatives and short-term trading. An investment company's purpose is clearly to make long-term investments. It is clearly unethical for them to be gambling with policyholders' money by shorting companies, by using derivatives with no underlying risk exposure in their portfolios. So I think we need to reimagine the role of the actuary, and I'm very keen on the public interest as a concept which all actuaries should be grappling with, and I'm looking forward to the debate that follows. Thank you.
Nico, thank you for being so eloquent in articulating a fundamentally different world from what we see today, and you bring the challenge to the heart of the corporation, and how we could move that definition and narrative, right? So we have almost two curves going on, two levels of conversation going on. You're picturing a world where our current measurements are totally inadequate in measuring the externalities and the true capital, of which money is not the capital. And we don't have wide enough a toolkit. And you, by your own admission, say that there's multiple perspectives, but you also anchor the opportunity for actuaries, which I think is a great opportunity for us to really go into the fundamental assumptions of the system we live in, which Lucy alluded to. That is a much higher order problem, but the world which, if I'm not retired, if I go back to work for Prudential or AXA, I go back to a world where my company, regardless what you say, places emphasis on growth and performance, which is based on the regulatory structure we have today, which goes into the heart of Ashok's Venn diagram. So there are two sets of issues. What can we do to this level, and what can we do to create, and how do we navigate between the two worlds? And I think this is brilliant. And I think that we must be able to hold let's just hold the multiple conversations together, because one is clearly a much higher level issue, but the real world is still full of conflict of interest, benchmarking, and people go to work, they still want their LTI, long-term incentive or bonuses, like tomorrow. Okay, and so what should we do? Okay, so with that, I would go to the fourth speaker, Nick Silver. Nick Silver, who is also a deep and rigorous thinker, especially in the investment area. I was very impressed when he recently challenged Mark Carney publicly that his 3 R's. I think the R stands for return, reporting risk and return. And he challenged Mark Carney on his assertion in his Reef lecture that the 3 R's are not good enough. In fact, if I were to read correctly his article, he said it was not only flawed, but was actually dangerous. Coming back to his, and I hope that he could repeat some of his arguments later on, and I believe he will. But his current position is he is the founder or chair of 3 initiatives organization: Climate Bonds, Radix, and also Kellen Consulting. And he pursued a wide variety of things. He was involved in City Business School, and has worked with the UN, World Bank, and 30 countries. And he was also been awarded by the IFoA, as well as the Fiatus Reward for his charitable efforts. And he's an author of a book called Finance, Society, and Sustainability. So with this, I introduce you, Nick Silver.
Thank you very much, Chieh. You're very kind. And I've come up with the 3 S's, as a vote, which I'll talk about a bit later. Well, these are such big and difficult issues, and I've having to follow Nico, Ashok, and Lucy, such inspiring speakers. And first thing in the morning, this is a really hard. So I wanted to take up the challenge to the profession that Paul Collier and John Chieh set out over the last couple of days. I'm going to focus on pensions in the UK. I mean, similar themes apply to other fields and other countries that we work in. In my work at Callan Consulting, I look at country-level pension systems. And if you boil it down, a pension system invests savings in a way that the economy can generate returns that can then pay back its pensions when they come due. And if I look at the UK objectively, we're doing a pretty rubbish job, really. Most of our pensions assets, I have down here 2.5 trillion, Ashok had a bigger number, are sat in zombie defined benefit schemes earning 0% returns in government bonds. I exaggerate, but only a bit. And whilst you have a minority of older people with gold-plated pensions, for younger people, a decent level of pension is basically unaffordable. If I were tasked with designing a sustainable pension system, I would not start from here. An analysis of the dysfunction of public capital markets, and John Kay, who spoke here on Tuesday, has written a lot about this, always start with public companies being subject to the tyranny of quarterly reporting cycles, making them take short-term decisions at the expense of long-term investment, something that Ashok talked to. And this is reinforced by senior management being compensated in relation to their company's share price. And they therefore incentivize to engage in activity which can be damaging, unsustainable, and not necessarily in the long-term interests of the companies themselves. Examples of things like loading the company up with debt and then returning money to shareholders, reducing costs by putting staff on low-pay, zero-hour contracts, lobbying governments to weaken regulation on things like carbon emissions and pollution, and avoiding tax, etc., etc. The quarterly reporting cycle is driven by investors who compete on quarterly returns. And why do they do this? Well, we actuaries set mandates for investors based on these metrics. John Kay convincingly argues that the fund management industry only adds value as a whole, not by competing against each other on returns, which, as Ashok said, is a zero-sum game, but by wisely stewarding the companies which they own. Yet most investment managers see this activity as a waste of time and dedicate very little resources to it. Now, I appreciate that mandates nowadays are much more complex than just monitoring quarterly returns, but it is safe to say that not many or any make stewardship their top priority, which John Kay would argue is what they should be doing. Now, we actuaries also set the asset allocation of a large chunk of our society's assets, as Ashok also mentioned, and these are almost entirely invested in financial assets. So, for example, the stock market returns money to shareholders rather than invests it. Only a tiny proportion of institutional investment goes to infrastructure or small growing companies or to R&D. Yet, as Paul Collier called us out for yesterday, it's this investment that a country needs to be able to pay back its pensions in the future and also to move towards a zero carbon sustainable economy. Why is this? Well, regulation is based on the fallacy of composition. It makes the false assumption that pension funds and other institutional investors optimizing their own risk return which therefore causes them to prioritize liquid financial assets will ensure an optimal outcome for the system as a whole. But for the system as a whole to function properly, the economy has to generate returns, which requires real investment. So real investment needs to be preference over financial assets. The reduction in real asset allocation and the adoption of shareholder maximization coincided with actuaries changing our methods in adopting mark-to-market solvency valuations. And this was no coincidence, because this is the result of the supremacy of financial economic theory, the very same theory that John Kay, Paul Collier, Mervyn King says doesn't work. We actuaries made a conscious decision to adopt this methodology, and I strongly feel that this has inadvertently damaged society by reducing investment in real assets and incentivizing companies to make short-term decisions and pass on externalities to society. You could argue that we are forced to act in this way by regulation, but regulation is itself heavily influenced by dominant economic theories and professional practice. So what do? It's not individual actuaries that can do anything by themselves, but collectively we can. Kay argued that the defined benefit schemes have been regulated out of existence, and this was because of a lot of short-term policy mistakes made by successive governments. But this is not surprising, because pensions are highly complex and governments don't have the expertise. They are not qualified to make decisions on pensions policy, but we are the experts. We should be telling them what to do. A lot of actuaries currently earn their living from advising defined benefit schemes, but defined benefit schemes are dying out. This work will not last forever. Surely we should be utilising our skills to develop a sustainable long-term solution for pensions. From society's point of view, our valuable skills and expertise we have built up over many years are being wasted. As a first step, I propose that the IFoA commission a high-profile prize competition for proposals for a sustainable pension system. Entries should be judged on how they achieve certain objectives, which I term the 3 S's: the sharing of risk equitably, sustainable investment which generates returns while achieving social goals like decarbonisation and levelling up, and looking at the system as a whole, which needs to be resilient. Also, I couldn't fit in the 4th S, which is stewardship, which I talked about before. In the COVID crisis, we often hear that policy should be guided by the science. We are facing a long-term pensions crisis of our own making. So why is pensions policy not being guided by actuarial science? And that it is not is our fault. As Paul Collier said yesterday, we need to stick our heads over the parapet. So thank you very much for listening to me. And I've also been following the excellent questions which have been asked, so look forward to discussing them later.
Thank you very much, Nick, for the practical suggestions for actuaries, right? But if I were an actuary, I would be concerned about the context which I'm operating in, operating in, and see how well that will fall into my circumstance, because you do require some degree of reciprocity and neutrality. You can't do it on your own. But that, put that aside. But I'm also curious that we have been talking about financial theory, pricing, and public interest. And there seems to be a discussion that if you could fix the economic theory to wider measure, all will be well. And I wanted maybe people to reflect on this, whether are there other societies which are doing this well, where the CEO pay and pursuit of personal self-interest is not so excessive, but no society is perfect, or has UK and US, what I call the Anglo-Saxon society, it has overswung, yeah. Whereas European nations may have less of this issue, but their issues could be other types of issues. So I want you to hold that space. And before I go to the question, the other thing which I want speakers to, panelists to think about, maybe 2 or 3 practical ideas towards the end, which you could think IFoA could do to help carry the conversation forward. So I'm going to go to a question proper. We got many questions coming in and all very good questions. And I want to start with Graham Charter's question, because his question goes straight into the Venn diagram of Ashok. Yeah. So I think that maybe Ashok, you will have the privilege of handling this. And Graham Charter's question was, where do regulators get their advice when building regulatory system? A question we could ask Andy Holiday next week as well. Is it not from actuaries and other professionals, enthusiastic ones? How specifically would you recommend insurance regulations move away from market consistent championed by IFoA? What valuation principles would you champion instead? These are substantive questions. I should try to unpack this, and I would welcome Nico's and Silver's and Lucy's contribution, but we don't need everyone to answer every question, so that we can have a variety. Ashok, you want to have a go at this?
Yeah, thanks, Chieh. Look, I think that's a really fundamental question that Graham's asked. It was very interesting. I was fortunate to have the experience of working with the Bank of England, and that's an education in itself. And one few things I realized is, one, that the Bank of England is very influenced by economists. It's a lot of they seem to have a dominant influence on its thinking, and I was struck by even before the global financial crisis, the insurance industry and actuaries were deemed to have failed in their management of risk. That was a general sort of belief brought out in the Morris Review, etc. And there was a belief held by the regulators, the FCA at the time, that the investment banks were better at managing risk than actuaries. And so what they did was they basically imported investment banking techniques into the management of long-term instruments. And I think through that, we've converted long-term investment into trading. We've made long-term investing institutions behave like traders. Now, how do you actually get away from that? And I think that's where we as actuaries have got to state the intellectual case. And it's got to come from the profession, because the regulators will not be influenced by individual firms who they'll view as having a vested interest. And by us coming up with reasons why the way we measure things is not working, and if we were to measure things differently, it could achieve different things for wider sets of stakeholders. Within FinStick, we're trying to do a study of stocks and flows in the investment industry, and we're hoping that will actually be the sort of evidence that'll help the regulators understand why capital is not reaching the right places in the way it should.
I think that's a good start. And I will welcome Nico and colleagues' intervention because Ashok, you mentioned that actuaries have to build the intellectual case. Yeah, and I think that we are only scratching the surface, because the intellectual case on which financial economics was built was developed over 40 years, and it was also anchored on a political philosophy of self-interest and market knows best, right? And even Mark Carney himself, when he was the Bank of England chairman, and also Mervyn King was endorsing market knows best, right? But now we are saying that market doesn't know best, right? So we need to find an alternative. And is it going to be quantitative in nature? How different it is? I doubt one profession would have the intellectual bandwidth, right, to do that. But we hear what Paul Collier said yesterday, right? There is an intellectual sea change. I think that is probably true, because we find current zeitgeist unacceptable. I don't know, Nico, you want to add into this?
Yeah, I mean, so maybe to come to the question, so I guess where do the influences come? I would say fundamentally from scandal. So a lot of the regulation in the UK is an activity of trying to close stable doors after the horse has bolted, and politics. So either the fear of the current government being blamed for that horse bolting again, or from the anticipation of the opposition as they come into power of a horse bolting. So we have a very accretive regulatory system. It's very easy to add regulations. It's really very hard to take them away. I'd say the third influence is the industry that is being regulated. And I see this a lot in the pensions industry, where essentially the highly profitable investment managers are the ones who are lobbying the regulators to ease specific parts of the regulation which will suit them. So I think our regulatory system is kind of very reactive, and really not fit for purpose. But that is probably because we are not fit for purpose. I prefer a principles-based regulation which trusts the corporation to act in their client's interest, but the financial industry time and time again says it refuses to do that. And it overwhelmingly acts in its own interests against its client's interests. So you have an overarching regulation. So we're going to come back to the word culture a lot of times. But that overweening selfishness and the neglect of those additional capitals and the things that you sit outside of your company but are vital to them, if we can shift the culture towards understanding those things and respecting them, then probably we don't need the regulatory architecture that we find ourselves with. But that is a very long, very slow journey to change the culture of a nation and our industry.
There's a highly meta issue and indeed a very multifaceted wicked problem. Yeah, wicked problem. But the fact, I don't think we need to have we don't have to have a strong need to have a quick answer, but an appreciation that we are actually concerned that the current system doesn't quite work, which is quite a victory in itself, right? But in the meantime, our education and training has to go on, and how do we navigate it in a very thoughtful way? I'm going to move the conversation to a slightly different part. But if all of us could see this problem at different levels, yeah, and at the highest level is how society is organized, and then at the lowest level could be how products are priced. But they're all interconnected, yeah, they're all interconnected. But here I want to bring in a question from. Sorry.
Okay, can I answer that question?
Of course.
Can I have a go at that question, Suee? Yeah.
Of course.
So actually, yeah, that was, Graham, that's a very interesting question, and actually I thought a lot about it, but the Marxist Italian philosopher Antonio Gramsci talked about hegemony of ideas and war of position and war of maneuver, and I don't think it's so simple as things being reactive. There are different intellectual ideas, and different sorts of parties take up those ideas which suit their own, power influence, and also, as Nico did say, the regulator is often reactive. But over the last 20 years, this market fundamental neoclassical position has been dominated because it suits different people for different reasons to be the dominating. And then regulation is written under the influence of this thing. But now this has been intellectually challenged, and so we're probably moving to a different paradigm where we'll have a different arrangement for regulation. And I think, Graham, you asked a question about, well, what would it look like? And I think actually you've got to get the basis, the sort of worldview. So the worldview of over the last 20 years has been the market knows best, and risk is measured best by the market. And we're moving to a different one. I don't think it's quite been settled what that is. And it actually probably comes down to purpose, like what's the purpose of investment, what's the purpose of finance, and like what's the purpose of pensions anyway. So I'll hand back. Sorry, Suee.
Well, Nick, Suee, I love your answer. Right? From market knows best, what is the alternative to that? So we are in search of that intellectual framework and foundation, because our friend Graham Charter's question is a highly practical one. And I don't think we have really answered him, right? He said that how specifically would you recommend insurance regulations move away from market consistency championed by IFoA historically? What valuation principles would you champion instead? I say that we are still skirting around. We are still skirting around, and it's okay. I'm saying because we go into a very high basis, but we have not really answered this question. Tomorrow, what do we write in our response to the call for feedback, right? But I think that we need to hold this space, right? Because we couldn't really answer the question, because someone still need to apply this in their company when they go back to work. Okay, Nico?
Yeah, I mean, sorry, I'll give a very quick answer. We look at the future projected dividends or coupon payments, and you discount them by your expected return. So we used to have a mechanism. All of us were taught it, those of us of a certain age maybe, and it was destroyed and overthrown by market knows best. So we've already got the mechanism. We just need to recognize a process of having two mechanisms which may not always agree, and that's a governance problem. So we have the mechanism, we just need to put it back onto the.
So there's a dividend discount model. I remember that dividend discount model, and then Tesla will be valued at zero. Yeah. Okay.
No, I think Tesla, that you project out as the future where it might have some profit.
Okay, and then judgments comes in. Okay, we're not going to have that debate is worth having under a separate heading, yeah. But not today. We got to go back to the main river. Otherwise, we go into all the tributaries. Yeah. I want to ask a question on fairness. Yeah, and I'm going to direct this to Lucy, because it's on intergenerational fairness, and it's from Martin White. And his question: isn't one aspect of intergenerational fairness a question of whether you are lucky to grow up at a time when asset prices are low, or unlucky to grow up when asset prices are high. In today's world, we arguably have the highest asset prices driven by lowest ever real interest rate, partly as a consequence of government instincts to fear falling asset prices. Can we speak up more about this as a profession? But actually, Lucy, more broadly, the issue of fairness is just a function of timing, right? And how do we smooth it over? And then there are rival economic theories now, right, about whether it really matters to have large deficits. Yeah. So I leave you to lead the conversation and invite other panelists to join in. We can spend 5 to 8 minutes so that we can have a great diversity of questions. Yeah. So Lucy, the floor is yours.
Yeah, I think I probably would encourage us to think away from sort of purely financial assets. So we need to be thinking in sort of real asset terms, but I'd also encourage us to look at sort of stocks and not flows. So really thinking about what is the current state telling us about the capability of future generation of returns. So when we're thinking about sort of capital, and we're thinking about actually measuring the impacts of our actions on the environment, if we're actually undermining the ability for future generations to provide for themselves and have the same sort of living standards as we do today, then that's sort of problematic. And the sort of interest rates is quite a big discussion around sort of multiple factors, but it sort of course, creates sort of intergenerational problems. But I think the fairness angle isn't necessarily just an intergenerational one, it's also an intra-generational one. So thinking about how certain policies might impact different members of society, and actually building something that is inclusive enough to make a transition possible, just to get the sort of political backing behind it. Things like the SDGs recognise that the two come together, and they're interdependent. So it's sort of really important. And I think from a risk management perspective, we've seen with COVID-19 that sort of systemic risks, and I include things like inequality and climate change and biodiversity loss in this, they really feed off pre-existing vulnerabilities in the system. So it sort of thinking about fairness is sort of a good risk management in my view. And I think one of the other things is sort of where we're getting our information from, making sure that all of the different voices are being heard, because actually we've got something to learn from everybody, and particularly sort of different generations will have different views about what they want and sort of what their sort of standards and their goals and things like that in life. And I think that's really apparent in sort of current younger generations, and I don't want to sort of make cast types here, but we are starting to see sort of movements and changes in sort of consumption patterns of people desiring more sustainable products, being more eco-conscious, that sort of thing, and that of course drives through back price signals to the market and allows sort of crowds in that sort of entrepreneurial activity as well.
That's a very good answer, Lucy. And actually, it's, if I were the young, I have a young daughter, and if you see the world, it's not about economics, right? It's also about sustainability, right? You're not leaving anything behind. Forget about economics, but of course we are thinking in economic terms, in terms of debt and in terms of pension and house prices, yeah. Which I think brings nicely to Nick Spencer's question on how we measure GDP, right? How we measure GDP, and that still is still a problem which eludes many nations, maybe with the exception of Bhutan and I believe New Zealand, right, and Holland, right? Could the panel discuss potential alternative thinking in setting economic objectives, and particularly how a focus on measures of inclusive wealth may have implications for traditional measures of GDP? But I would also encourage the panel to think about the movement into the current zeitgeist in terms of Milton Friedman's, Thatcher, Reagan, Hayek, Ayn Rand, the emphasis on market knows best, the individuals should be left on their own to pursue and maximize. Yeah, but now there seems to be a slightly change in emphasis on collective interest. And that debate is an interesting one, especially it also takes place during a pandemic crisis, right? But next question has had an economic feel to it. So if you don't measure stock prices as measures of performance, and we don't measure GDP as a measure of growth, what should we do in the next in the months or years to come? Who would like to have a go at that? Silver, could I ask you?
Yeah, sure. So obviously, you know, people know my background, think the GDP is not a very good. I agree that GDP is not a very good measure. It doesn't measure lots of stuff like well-being and environmental damage, and this has been criticised throughout its history. But the thing about GDP is, if GDP goes down, which it does periodically, everything goes wrong. Things fall apart. You know, you get high unemployment. Companies go bankrupt. So even if you stop measuring it, you still have these negative consequences. Yet, from an actuary, I just don't understand. You know, the GDP goes up and down, and it periodically it's going to go down. We're going to have a recession at some point in the future. So why not think about, well, let's look at all the bad things that happen in a recession and try and make them less bad or get rid of them, because they're entirely predictable. So the GDP just captures the fact that this economy, the way the economy works. But we actually need to address the way the economy works, not the measure. The measure is important, I give you that, but it's not actually the main focus. And I don't see really any economists, or many, I've hardly ever seen any economists, or I don't think I've seen any, saying, well, okay, the GDP is never, it's all about boosting growth. But they say, well, some point we can't always boost growth. Growth is going to go down. Let's think about doing having mechanisms which are counter-cyclical, which lessen the damage. And then we don't have to worry about GDP so much.
Any other? Lucy?
Yeah, I could probably pick up on that. And I think probably what we need is a suite of measures. So GDP has many limitations, one of which it only measures things that are priced. And the other thing is that it's a flow and it's not a stock. So it's not telling you about what your capacity for future performance is. And this is why when you're actually looking at this, you need something that is much more, is just much broader. It also doesn't tell you how things are distributed. So you might be getting a lot of GDP growth, but the majority of people might be just the same. They may not be having a better standard of life because actually all of that growth is being distributed to the top. But it probably doesn't need to sort of be taken out and thrown completely in the bin. It definitely needs cleaning up. There are things in GDP that sort of don't measure value, but they measure money. So we then probably brings us onto a conversation about, well, what do we actually value? What sort of things do we want to achieve, and how do we want to achieve them? And then what can we measure? I think when you start bringing in metrics, there's always a tendency to pursue that metric and sort of improve your performance against that, but not necessarily recognizing the limitations and sort of any sort of adverse incentives that you've created by introducing it.
Thank you.
Can I don't know how my internet connection is. Sorry, I've just had to change. So look, in my view, GDP is a terrible measure. It's, as Bobby Kennedy says, measures everything which is, I'll go on through the paraphrasing, but it measures all of the terrible aspects of society and none of the good. Fundamentally, it neglects to understand capital. So GDP would go up if we tore down every forest in the world, but it would go up for 1 year. So the measurement of GDP is about us deciding how to undermine the cliff we're sitting on. If we had measures of capital, and Vasily Leontief, who worked on GDP and introduced it as a measure, his same equations go into ecology, and they're used to measure flows in ecological systems. We would, and in ecological systems, you can look at capital and you can look at flows as being very similar, because to maintain a certain amount of biomass, you need a certain amount of sugars to come into your system. So in economics, those flows and capital are very different. So my sense is we should be moving it onto a capital system. And some of those capitals are things like happiness. But more importantly, probably for the sustainability of society, there are things like biodiversity and you know, the coverage of trees. So in terms of growth, I'm not convinced that we cannot grow if we measure capital appropriately. I am convinced that growth in GDP is unsustainable. And as Roger Balding says, only madmen and economists think that infinite growth on a finite planet is possible.
Nico, you wouldn't be surprised that I'm attracted to your intellectual elegance, yeah, of your arguments, yeah. But I obviously support the current drift of conversation. But I would, if I were sit in the audience, yeah, I got a number of questions, one of which is asked by Matthew Perman, which I will ask later on. If I'm a member of the audience, I would observe that everything we do was a result of the past, right? We are here today because it's sort of, we wanted to be, because we are a complex adaptive system ourselves, regardless of what Robert Kennedy said, right? You're here because, and every solution has its own problems. The question now is how to move to the next stage, right? How to move to the next stage, and what is the answer? I think that is where we are. But I think that would be a good place for me to find Peter Telford's not Peter, Robert Matthew Perman question. Okay, I think he's a very practical one, right? Because regardless of what happens tomorrow, tomorrow Friday, people wake up. Most people invest in companies to make money. Yeah, we can probably all make a good case for a long-term perspective that building capital and value will eventually deliver better returns. But the world has moved to much faster trading and regular performance measurements. And so how can you stop corporations delivering what their investors are asking for? Hold that question first. Because the narrative which we are part of today was a reaction in the 70s, yeah, and the 80s on how statism, quangos, and people who are trying to intervene with the system did not quite work, yeah, did not quite work. And as a parallel, Communist China under Deng Xiaoping then introduced, we don't care whether a cat is black or white as long as it catches mouse, and introduce a pursuit of private ownership in farms, and that unleashed the transformation of China. Yeah, so it was not working. So therefore, the appeal to private interests, and I would argue, it's not something we could exclude ourselves from that consideration. Yeah, we all of us have personal interest. The question is, how do we make all the jigsaw fit? But back to Matthew Perman's question. Tomorrow, how do you stop corporations, right? Because we are still under the stock market system. And the problem might not be so acute in other societies, right? You look at CEO pay, relative of pay in Britain and UK and elsewhere in the world. So maybe I could ask Ashok to comment. Yeah? Tomorrow we wake up, we still want to invest in companies who not necessarily according to the dividend discount model.
Suee, look, I think it's a really important question, and it's one that I see lots of organizations grappling with. And a few things I would say. One is that most organizations are today having they're having a sort of discussion or beginning a discussion about the purpose. And they're starting to recognize that shareholders are not the only influence on the organization, that they have an obligation. And even the FRC has opened up a debate on Section 172, which in the UK says that companies have an obligation to wider stakeholders, not just the shareholder. I think within our companies, company directors will have been told by lawyers that your obligation is to the shareholders, but they're even now starting to push back on that. So there is there is a change, and there is also another change which I'm recognizing around board tables, and that is the fact that our society is changing, and a significant proportion of our employees and our customers are demanding different things from our corporations to older generations. And if we're not careful, companies and boards are going to find that a significant proportion of their customers are ahead of them. And if you end up in a board where that is the situation, that's not a good place to be. And so I think boards have a responsibility to really think about this quite seriously and to think, what constitutes success for my business? And then to be brave enough to turn around to the investor base and say, this is what we think success constitutes for us. And to be prepared to say, well, if that isn't right for you, then maybe you shouldn't be a longer term shareholder of this business. And we should seek people for whom that is actually, who are supportive of what we believe is right for our business and for our companies over the longer term. And there's an important discussion here to be had on over what duration are we attempting to achieve success. And I don't think that is a discussion that enough boards are having.
Ashok, thank you for such a practical answer. What you are saying is that we may not have the magic answers in modeling terms, but the conversation is changing. Yeah, and you remind me of what John Kay said to us, or was it Peter Collier said to us about Toyota? But I think more relevant is his story on ICI. And I can still remember a CEO by the name of John Harvey Jones. He was appalled that I think he was only earning £80,000 at the time. He was a CEO group of ICI before it changed to maximization of profits, about how London traders were earning multiples of his salary. Right? But I wondered whether I could have asked you a rider question, whether you have, whether your attitudes towards CEO and senior executive pay, especially in the financial services industry, right? Especially in UK and the US, do you have a view about it? And what can the professions or people who have public interest goes in their mind say about it?
Suee, I'm really glad you asked that question, and I'm going to give perhaps a sort of slightly different answer to. If you look at the rise of CEO pay, it is a direct relationship to the rise of transparency about CEO pay. And we all tend to think that transparency is a good thing. But as soon as we made CEO and executive pay transparent, that led to a race upwards, because no board is ever going to turn around and say, my CEO is in the bottom half, and therefore should receive below average pay. And so this is an area where I think transparency has actually created a huge problem for us. Now, how do we rein back in from there? I have a lot of sympathy with saying we don't need to pay people these levels of pay, but once you're on this treadmill, it's very, very difficult to get off it. I know Sun Life Financial, if you look at its CEO pay and its executive pay, it is bottom quartile, and yet it is one of the top 5 most successful insurance groups worldwide, measured by TSR over a 5-year period. So it's not necessary to pay your executives quite at the level we do, but it's very, very difficult to rein back against it.
Okay, that is a very practical and real answer. Matthew Perman, so the answer from within the corporation is that they've got to be wider. But as an investor, you are still left with a choice, right? Whether you invest in companies which maximize return or invest in companies which you believe will do long-term good, which actually turns into the 3R argument, which Silver was critiquing of Mark Carney. Yeah? But actually, we are in our last 5-6 minutes. It's amazing how time flies. But I was going to ask the panel, right, something very practical. Maybe I will start with Nick Suee because he's and go through the panel about climate risk, right? And very specifically, right, you know how council has very wonderfully voted for aiming for net zero by 2030 and so forth. What needs to happen to ensure that we transit into a world which is sustainable, right? Because from a layperson point of view, it looks like we are still marching. There are more conversations, more promising conversation, but is allocation of capital enough? I think by your own arguments, Silver, I think you are suggesting it's not enough. You got to do much more interventionist approach. Yeah? So maybe you could take us through your argument and see how you think IFoA should position itself, because one of the series for this thought leadership framework is on climate change and sustainability in autumn. Yeah. So Silver, the floor is yours.
You've asked me in like about a minute to solve how the world should solve its climate change problems and how the IFA should be about it. Okay, I'll try my best. So the world needs to, like, you know, that climate change is, I see it as an engineering problem, and you look at the different segments of which we need to address, and things like, you know, the next one is hydrogen and farming and things like that, and we need to work out how to solve those. I think from the IFoA's perspective, and actually going back to Matthew Perlman's question about how you stop corporations delivering what their investors are asking for, it's kind of, we need to, you know, the assets under our stewardship need to be invested in long-term sustainability, and the assets under our stewardship are not actually private assets. They're often, you know, government pension schemes. The biggest investors in the world are all government pension schemes, or people save for a pension because the government bribes them to do so by a tax benefit. And so the society is giving people who save something, is giving them a tax break, and it's so in payment for that it needs a, you know, reward. So you should be ensuring that the assets are invested for long-term sustainability, which is the only way that the system can then generate returns to pay back our pensions. So the difficult bit, which lots of people struggle from, we know what to do with climate change. We need to, you know, decarbonize our grid. We know we need to switch shipping onto hydrogen made by clean hydrogen, and we as actuaries have certain levers, and the finance has certain levers. Is how do you translate the two? So, but I think first of all we have to sort of fix our system. Like talked about the pension system, which isn't really working anyway for its own good. But you know, in that design, you can then build in, well, we know what we need to do, and our objectives of our investment, the objectives of society's investments, the economy's investment, need to be sort of, you know, argued about and defined. And one of them is going towards a low carbon economy. The objectives of where investment is invested now is not that, right? So, but I'm very also optimistic that since I've been involved in this space, the world has shifted so much. I would never have predicted Chairman of CEO of BlackRock would say we're going net carbon zero, or the Institute of Actuaries. So that's my very quick answer.
It's a wonderful quick answer, and there seems to be an intellectual sea change and inflection point brought about by pandemic and so forth. And IFoA is well poised to take advantage, to be part of the conversation. That's what I would say. I think what is happening in IFoA is a manifestation of the change in the world. I'm going to ask each of the speakers to comment last minute thoughts, because I got to close, and there are many other contributions from the floor which I want to acknowledge and to encourage them to be part of either a number of groups. Maybe I just go around with Lucy, Ashok, and then Nico. Yeah, last words.
Yeah, I think I'd just encourage us to think about our role as universal owners. So pretty much anybody under the age of 60 now is going to be impacted by climate change, even with mitigation, even with a green transition. So really think about what we value, what our purpose is, and how we then align with that. We need absolutely everyone. We need the public sector, we need the private sector, we need local communities to come together and really tackle the problem. And I think as actuaries, we have enough information now to know that this transition needs to happen. So we probably need to be less worried about putting an exact number on something, but because of radical uncertainty, you can't anyway. and actually just thinking about, well, what levers do we pull to deliver those solutions? In terms of sort of getting involved, then just find the groups within the IFoA that are already having these conversations and are challenging each other's views and making each other's arguments much more robust, and actually having debates around our role for the public interest and what that means for us and society.
That's very good. Nikki, could I encourage you or ask you to put up the QR code so that people could click on the feedback, so you all can multitask, do the feedback form. We appreciate it, so you can fill up the form to tell us what works, what doesn't work, and what you like to see in the future. Nico and then Ashok.
Thank you. Yeah, I think I've got comments for the IFoA. So fundamentally, I think what we've heard is the need for the IFoA to say very strongly, publicly and to government, that market does not know best. I think a number of people in the audience, a number of our members will hear that as being a political statement. And I would urge you to remember that being apolitical is a political statement as well. It says that the current paradigm works. And I think what we're hearing and the sea change that you're outlining there, Suee, is that the current paradigm does not work. And it is time for the state to reimagine itself. I think we've seen in the pandemic in the UK, you know, both the successes and the failures of a state lurching into a role as organizer in chief. And I think there's a lot of lessons to learn from that. And I would hope that the IFoA can start to articulate the good and the bad of state intervention in markets, essentially, and kind of litigating and regulating some of the discussions that we've had today.
Nico, you know that my intellectual sympathies is in similar direction, but IFoA is us. It's not me or Annette, it's us. We are the profession and we are a broad church. We are a broad church, but there is a sea change in opinion, and we could be slightly bolder. But we need people who has the capability and the time and the thinking to spend time on this, because it's not going to work just because we say that it's on our agenda and therefore we have a meeting over it. Because it really has to be pursued with immersion and passion and commitment, and we are beginning to see quite a lot of people, right? I would like to pay, if it's not too controversial, people who are in a sustainability board, Lucy and Nick Spencer and Louis, past chair, FinStick from a very different direction, then looking at alignment. The economics members interest group whose presence is here, and Oliver did ask a question, but we just got too many questions, but Martin White was their rep. So there are pockets, and increasingly I think they are going to be very important communities. And it is, and I know that the team at IFoA and Annette's team will support us, but we got to get our thinking around, because it's a complex issue and there is a diverse range of views as being asked by people who are practitioners. So with that, Ashok, could I ask you to have your last words before I sort of wind up?
Look, I think there's a huge opportunity for the actual profession. I was very taken, Nico, by the way you described the actuary and the role of the actuary, and I thought the multidisciplinary skills, the perspectives, etc., lend itself to systems thinking and looking at our financial systems and understanding where our financial systems are not delivering. And I do believe that through the profession, there's opportunities for actuaries to work in that area and to provide the profession with a louder voice, and for the profession to speak out more on these issues.
Okay. Have you finished, Ashok?
Yep. That was
Thank
it.
you, because it's like, okay, Ashok, I like the way you round up, and also there are a set of issues for us to resolve in one curve, But the curve which is also unpacked here, which I think Nico spoke to it quite well, is that there is an opportunity for IFoA to be on the front foot intellectually to set the case for long-term sustainability and the pathway forward, right? It could be a Reddington moment, you know, for the profession. It could be a Reddington moment for the profession. So collectively, it doesn't have to be one person. But it clearly, and it's very much in the spirit of VSMD, right? About skill sets, mindsets, and bring other disciplines to bear, because this is clearly a wicked problem and actually requires a cultural and psychological dimension as well. And if you can bring all that together, and I think ethics come into play without doubt, neutrality come into play. So I think that's great. I want to apologize to many people who asked questions, but we just couldn't, there are 51 questions, we just couldn't answer, but I thank you for your time. And I'm going to draw a conclusion by saying again to all of you for thank you, and thanks again to Dr. Patrick Poon and Milliman for their generosity to make this event available to members and non-members free of charge. Yeah. So the final session is on Tuesday. We have John Kay, whom we have met, and Sir Paul Collier, and he will take once more with the chief economist of the Bank of England. Yeah. And if we are over-dominated by economic thinking and by regulatory agency, this is the place to question. Yeah. And I'm accompanied by my presidential colleague, Luis Saye, to help me actually to intermediate, and also to give our own actuarial professions perspective. And I hope you enjoyed today, and look forward to seeing you on Tuesday. So with that, I think we will conclude today's event. To thank all of you again, your participation, and I would like to thank the team who is working very quietly in the background, Annette and her team, Nikki, Henry, and Kathy, for today and also the last 2 days, and for more to come on Tuesday. So that I bid you a good day ahead, and good evening for the people in Asia.